Welcome to RBC's Markets in Motion podcast, recorded June 15th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, forward PEs have generally been de-frothed but haven't looked deeply compelling for the major U.S. indices. This is supportive of a rebound in the near term, but may eventually cap upside before another breather is needed. Second, the valuation case for the broadening trade still has some room to run, but requires close monitoring. If you'd like to hear more, here's another 5 minutes. We'll start with takeaway number 1. Forward PEs have generally been de-frothed, but haven't looked deeply compelling for the major U.S. indices. We closely track daily forward PEs for the S&P 500, Russell 2000, NASDAQ 100, and top 10 S&P 500 market cap names on both an next 12 months and FY2 basis. What we're seeing across the data set is supportive of a rebound in the near term, but may eventually cap upside before another breather is needed. At last week's lows, we generally didn't get back to even the March 30th lows, which were also generally not in line with the major lows of the post-COVID era. The S&P 500 weighted median next 12 months PE did come close to hitting March 30th levels last week. After making a slightly lower than usual peak of 26.5 times, this version of the S&P PE fell to 21.5 times in the middle of last week, close to its April 2025 low of 21.1 and not too far off from its March 2026 low of 20.8. However, we saw far less improvement in the Russell 2000, which on a weighted next 12 months PE basis saw a high of 19.8 at its most recent peak before falling to 19.1 last week, well above the past 4 major lows, which ranged from 13.2 to 16.4. Meanwhile, the top 10 market cap names in the S&P 500, our favorite proxy for the mega cap growth trade, came in somewhere in between. On an equal weighted next 12 months basis, that PE fell from its latest high of 31.6, like the broader S&P 500, a slightly lower high than the previous ones in the 35 or 34 to 35 area, and it went down to 26 times. That was down a clear notch, but still well above its most recent lows in the 19 to 23 times range. So what signal does all of this send, particularly given the latest news on Iran? In our opinion, valuations aren't standing in the way of a rebound, but we don't have a lot of room available before the ceilings of the recent past are retested. We come to the same conclusion after reviewing our sentiment and positioning work. Net bulls on the weekly AAII investor survey fell sharply last week to minus 17.3%, a deterioration versus the prior week's reading of minus 0.70, and a move that took the 4-week average down to minus 9%, almost 1 standard deviation below its long-term average. That was a decent-sized hit that gives us some springboard, though it's also worth noting it didn't quite make it back to the March 2026 low of minus 21.6. Meanwhile, U.S. equity futures positioning per the latest update from CFTC also showed a retreat for U.S. equities, but less significantly so, and with overall levels still pretty high, roughly 1 standard deviation above average. Let's move on to takeaway number 2. The valuation case for the broadening trade still has some room. We're talking here about small caps, certain cyclical sectors, and non-U.S. developed market equities, but we do think this requires close monitoring. First off, the Russell 2000 no longer looks deeply compelling relative to the S&P 500 on a next 12-month PE basis, where it's getting close to average. It does still hold significant relative valuation appeal on an FY2 PE basis. This suggests to us that the case for small caps over large caps from a valuation perspective has eroded but hasn't completely disappeared. Second, 2 of the more cyclical value-oriented sectors that we've been overweight, S&P 500 materials and financials, have seen their valuation appeal erode slightly as well, but not disappear completely. Both of these sectors are now slightly above their long-term average on an absolute median PE, but still below average on a relative PE basis. Our regular readers will note they've moved out of the green on our grid and into the gold. And third, the U.S. is starting to look attractively valued versus non-U.S. developed market equities again, as the next 12 months PE between the 2 cohorts has now dipped slightly below the 5-year average again. We are not back to the levels seen prior to the Iran war, however, which really reopened the door for U.S. leadership to return. Small caps, cyclical sectors, and non-U.S. developed market equities are all often thought of as important parts of the broadening trade, away from leadership by U.S. mega cap growth AI-focused stocks. Overall, the data suggests that while the broadening trade has room to run, perhaps supported by the latest war news, but investors will need to stay vigilant for the time when they have run their course from a valuation perspective. We'll wrap up with our bottom line, for now at least. In recent weeks, we've been concerned about the rising possibility of another short-term Tier 1 garden variety pullback of 5 to 10% in the S&P 500, while remaining constructive on the S&P 500 longer term with our 12-month price target of 7,900. On the longer-term 12-month view, there's been no change in our constructive stance. It will likely take some time to understand all of the ramifications of the weekend's news, but we see the developments as pointing to potential upside in our price target. In the near term, the weekend's developments on the war have lowered Tier 1 pullback risks for now, especially since the recent dip had already taken the index down 4.5% from peak. Not quite back in Tier 1 territory on our 4 tiers of fear framework, but getting pretty close. We do still see some short-term risks, though, that haven't gone away, including the midterm elections, the potential for downward revisions to consensus EPS forecasts for 2027, which could manifest later this year, and further profit-taking on semis, which simply don't look cheap yet. We will also be keeping a close eye on how views around the Fed, rates, and inflation are adjusted in the weeks ahead, as this had become one of the more concerning issues that we've been monitoring. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.